The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
An already rough and tumble week gets a bit rougher. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. We're kicking you off to the closing bell here in the U.S. Let's take a look at where we stand. We're off our worst levels of the session, but that's not really good news because we're down about 1% when it comes to the S&P 500, a little bit more when it comes to the NASDAQ 100. It's another important day for the tech sector. We have Amazon reporting after the bell. So you can see, again, a lot of red here on the screen. That's actually sending a haven bid into the bond market. You can see the 10-year Treasury yield lower by 6 to 7 basis points. We were sitting at 420 on your 10-year yield. And then take a look at Bitcoin. Just an absolute wipeout underway. Bitcoin down about 10%. We are at $65,000 per coin. Just 2 or 3 weeks ago, Romaine, we were above 90,000. So it really has been stunning, this fall from grace.
Yeah, back to the S&P here, 6,800 and change, a break below that earlier in the session here. But unlike the previous 2 days of the sell-off, where the majority of the stocks actually rose today, the majority of the stocks in the red, an indication that sentiment is indeed deteriorating. The percentage of NASDAQ 100 names out there, that's been pushed down below their 100-day moving average this week, surpassing 50% for the first time since late November. Momentum now working against the market, now with the widest differential between a pure momentum factor portfolio and a value portfolio, the widest gap in at least 5 months. Also, unlike yesterday, there is that strong bid that we are seeing into treasuries. In fact, the strongest bid to long duration since early November. And like yesterday, we're seeing that continued unwind of leverage in Bitcoin, liquidations accelerating, the funding rate for perpetual futures turning negative. Bitcoin prices now erasing all of the gains since the Trump bump from early last year.
Was not supposed to act like this, right? You had gold prices higher, the NASDAQ higher, rates going lower. This was the Trump administration was very pro-crypto. And so, something went wrong.
And then you have the ballast of the strong economy also starting to show some strains. We learned today that U.S. job openings unexpectedly fell in December to the lowest since 2020, while job cuts in January more than doubled from a year earlier. And if corporate earnings were supposed to save the day, I'm sorry, Alphabet's 20% surge in revenue last quarter and 30% surge in net income, that's not enough to sway skeptical, overextended tech investors, which, Katie, may not bode well for Amazon earnings tonight.
Yeah, just about an hour to go until we get those earnings. Let's talk a little bit about CapEx, because you saw a little bit of a tantrum thrown last night when we saw those numbers coming out of Alphabet. CapEx coming in much higher than expected. Here's the 2026 CapEx outlook. Here you can see Alphabet up at the top, more than $182 billion bookmarked for spending here. Amazon, of course, I would expect this to refresh after the bell, as well as some of these other names. But you can see the digits that we're talking about here. These are large, large numbers. And we're at the point in the cycle where sentiment has deteriorated to the point where that question of whether or not we're going to see a return on some of these investments, it's only becoming more urgent. And Romaine, again, the next test comes after the bell tonight when Amazon reports earnings.
Absolutely. And we kick it off right now, heading into that big earnings report after the bell with Sinead Colton Grant, Chief Investment Officer at BNY Wealth. All right, Sinead, let's talk about the short term for a second here. I know there's some longer term stories here that probably do suggest there are more gains potentially in store for this market. What's actually happening this week? What do you make of it?
Well, so here's the thing that we shouldn't forget. AI is really the fourth industrial revolution. And what we're seeing now is an assessment of, okay, given some of the potential disruption that we could see, let's take some money off the table before we figure out who the real winners are. Because think about what's happened over the last, call it, 20 years or so. You've seen disruption with .com, you've seen disruption with streaming for media companies, and the companies that don't make it, they fall off really, really quickly. And I think that's what you're starting to see, some of that almost more of a healthy skepticism creeping in. And
there is some disruption afoot here. I mean, earlier this week, we were talking a lot about some of the software companies sort of taking a leg down, largely because of the perceived advancement in AI that may actually sort of crimp into some of their dealings, if you will. And then earlier today, we actually heard their Anthropic had come out with some financial research tool, and that sent a lot of those stocks down as well. Is this kind of normal when you have these type of inflections in the economy, where you are making these big transitions, that you do have to have these kind of shakeouts?
I think that's true, right? Because it is not a rising tide that lifts every boat. The thing that we're really starting to see are which are the companies that are really embedding AI in their day-to-day activities and are going to benefit. Because the ones that do are really going to soar ahead. Now, that does not mean that every tool is going to replace a company that does that in a more analog way today. Analog, probably not quite the right word, but in a less AI forward way today. But the key is, how do you use it? How do you leverage it? How do you become more efficient?
But even still, I mean, you take a look at some of the reaction, the drawdown on some of these software stocks is breathtaking at this point. Do you think this could be an overreaction? Because the threat of AI has been around for years at this point in its current evolution. And it just feels like this week is the week that we just woke up to that risk. I know that Anthropic had some specific releases there, some specific catalysts, but even still, this isn't a new risk necessarily.
That's absolutely correct. I mean, think back to when DeepSeek was launched, right? We saw a very similar type of market reaction. And if you really start to look under the hood, not all of these tech names are created equal, right? You start to think about the fact that we're potentially in a memory super cycle because of the increased demand for memory from AI servers. We already know that capacity is pretty much completely depleted for 2026. So really, should all of those names be selling off in the same way? Probably not. And what you're going to find, and this is what we talk to our clients about, the smart money takes opportunities in times like this to look at, okay, so who are really the long-term beneficiaries?
Yeah, it's going to be fascinating to see who steps in to catch some of the knives that are falling in the software space right now. I do want to talk a little bit about Bitcoin, because what a wipeout that has been. It looks like we're getting close to cracking $65,000 a coin. Is there anything you can extrapolate on what is going on in the crypto market over into traditional risk assets, or is that just in a world of its own right now?
Well, here's how we think about it, right? We think about Bitcoin as really being almost a supercharged tech investment. And so to see this kind of correlation when you've been experiencing large movements in the tech sector, not hugely surprising. The other thing that we tend to forget about is that the realized vol of Bitcoin sits at around 50-60% over the last 3 years on an annualized basis. And so to see these kinds of moves is not unusual for an asset with that level of volatility.
And I think Katie just jinxed it a little bit, too, as she was speaking. Bitcoin actually dropping below that $65,000 level. And it gets to this idea about, a lot of people have talked about that basically rotation is kind of the new momentum, that what we're seeing isn't a sell-off. It is truly indeed a rotation. But when you see sort of almost abandoning of what had been one of the riskier, most speculative assets out there, does that sort of presage potentially that we could see a further unwind across other asset classes?
Well, look, I mean, you said at the beginning, we're looking very short term. So over the next couple of days, of course. However, this is where you look for opportunity. We remain very constructive on the U.S. economy, on U.S. markets. We think this represents a broader opportunity. Now, the rotation is important, though, because as we look out for 2026, we expect you're going to see earnings of about 311 over the course of the year. That gives us a year-end target for the S&P of around 7,500. That means two things. One, we're seeing more of a lift come from that earnings growth of around 13-14%, which is what we're expecting. But also, you're seeing broadening. And some of the sectors that we like include industrials. We also still like financials because we're expecting a few more rate cuts.
Is there anywhere that you would stay away from right now? You just walked through, some of your preferred sectors right now, but especially in this environment, is there any specific type of stock or industry that you would just steer clear of at this point?
Look, I think healthcare still remains challenging. There are some great companies within the sector, but they are significantly exposed to some broader political risk that is hard to quantify. Again, some potentially great developments, but look, we see patents expiring in some of the GLP-1 drugs, which have been doing so well. We expect that market to continue to grow, but that doesn't necessarily mean all margins are going to continue to expand.
All right, Sinead, always a wonderful insights. Sinead Colton Grant is Chief Investment Officer over at BNY Wealth, keeping a close eye here on the sell-off cross-asset wise. But we're all going to talk about some of the bright spots out there. And believe it or not, it's in the trucking market. XPO, those shares hitting a record high at one point on the day. We're going to catch up with the CEO and Chairman, Mario Harik, to discuss the company's latest profit beat and his outlook for the entire trucking sector.
And from the world of trucks to the world of fashion, Joanne Crevoiserat, CEO over at Tapestry, she's here to talk about her company's results and how the Coach brand specifically helped fuel a second quarter beat.
And about 25 hours ago, we were all hanging on every word out of Alphabet. Tonight, a repeat, this time with Amazon. Those earnings expected to cross shortly after the bells tonight. A close look at AWS, a close look at groceries, and and everything else in that space. All that more coming up in just a bit. This is The Close on Bloomberg.
Bob's Discount Furniture hitting the public market today in an IPO, raising $331 million. Trading under the ticker Bob's, the debut marks the start of an expansion for the retailer and an early entrant in what's expected to be a busy slate of 2026 IPOs. Joining us live from the floor of the New York Stock Exchange is Bill Barton. He is the president and CEO of Bob's Discount Furniture. Bill, it's great to have you with us. So Bob's Discount Furniture, founded in 1991. Why go public in 2026?
Well, first off, thanks for having me today. We're really excited to be holding our IPO today, about 35 years from the very, very beginning. Today, the company's been built out. You know, we have the team in place. We're ready to go. We've demonstrated the portability of our model. We have stores coast to coast. Our products are in place, so everything's just in place. It's a great time for us to go public.
And I am curious, you know, as I mentioned, you've raised about $331 million in this debut. How do you plan to spend the money? What's next for Bob's?
Yeah, so that money will actually go to pay off all of our long-term debt. So we will be completely debt-free as a public company, which is very exciting for us. And of course, we generate all of our cash flow goes towards growing. So as we pursue that 500-store model, our operating cash flow and our free cash flow are strong. But again, the money we're raising in the IPO today is going to pay off all of our debt.
Bill, I am curious going forward here just about sort of the nature of economic cycles and how, if at all, that impacts your business. Obviously, furniture isn't the kind of thing that, you know, we buy regularly. We buy it once, and hopefully we don't have to do it for a while here. Is there more of a kind of a recurring revenue model baked into what you're doing?
Not that so much. Really, the strength of our model is the fact that furniture is always being bought. Right, there's always these life moments, whether it's the young person setting up their first apartment or a young couple setting up their first home or maybe a couple retiring and downsizing. Those continue, and as we say, value is always in vogue. So for the last 35 years, we've been growing and taking market share in good times and challenging times. So we're very confident in our model and our comp growth and, of course, our unit growth. So we're very excited coast to coast, and we're continuing to grow.
I am curious about the marketing, at least for those folks in New York City. I mean, your commercials are ubiquitous. I am curious about other parts of the country and whether there is the same level of brand awareness.
Yeah, well, it's a great question on brand awareness. So as we think about entering new markets, for example, California a few years back, we take on average 2 years to study the market and really work on building our brand awareness. Today we have 45% brand awareness nationally and over 70% brand awareness in our major DMAs. So this last year, for example, we entered North Carolina for the first time, and we entered with strong brand awareness, but then we leaned in with our iconic marketing to drive that fun, friendly, iconic image that our brand is known for.
Absolutely, and you can see we have your little character on the screen right now. So Bill, as I understand it, you have more than 200 stores right now across 26 states. Your intention is to grow beyond 500 locations by 2035. How do you map out that growth? Are you looking to add more states to that or just expand your footprints in the states that you already have a presence in?
Yeah, it's a great question. So as you think about the 300 additional stores that'll come in the next 10 years, you can roughly break them into thirds. So about 100 of those will be infill stores in our existing 5 regions: New England, New York, the Midwest, and the West Coast. About a third of them, about another 100 stores, will be in the Southeast. And as I mentioned, we've already entered the Southeast this last year in North Carolina. And then the last third will come from the Texas, Rocky Mountain, and Pacific Northwest states as we flesh out our penetration across all 48 states.
So, Bill, when we talk about this idea of the growth that we've seen, I know you've been a private company. It's obviously very different to operate a private company versus a public company, have that scrutiny of investors, having to sort of answer to them on a quarter-by-quarter basis. Are you ready for that?
Well, it's a great question. We've been working hard over the last couple of years, Raymond, to make sure we're ready for this. We built out the team. Our CFO has built out his FP&A team and all the things that you need to be a public company. And in fact, we've been operating on a quarterly basis as a private company now for a couple of years, just getting ready for this moment.
All right, Bill. Well, congratulations on the listing, and hope to talk to you again soon. Bill Barton, President, CEO of the newest listing there, Bob's Discount Furniture. A sale last night at $17 a share and open right on the nose at 17, a high today at $18.88, and right now trading right around 17.5 bucks. When we come back, we're going to take a look at some of the names going to the downside. Big asset managers in the private capital space, including Blue Owl and Ares Management. Both reported earnings, and the earnings were actually good, but that's not really what investors are focused on. We'll explain what's happening when we come back after the break, right here on The Close on Bloomberg. Time now for our top calls. Big movers on the back of analyst recommendations. Let's start off with Qualcomm. Bank of America downgrading the chip maker to neutral, cutting the price target to $155 from $215. Bank of America says even though the stock is relatively inexpensive after forecasting weaker than expected revenue, there are limited near-term catalysts. Those shares, as you can see there on your screen, down 8%. Its worst day going back to May. Next up, Steve Madden. Jefferies cutting to underperform. The price target down, set at $30. The firm says mounting and persistent wholesale pressures will continue there for the shoe retailer. Those shares having their worst day since April. And last up, Microsoft. Stifel cutting to hold. The price target, the 540 price target, that's cut to $392. That's the second lowest on the street. The analyst says consensus estimates for the following year are too optimistic. And some of those bets out there on the accelerating pace of growth in the Azure business, that's likely misplaced in the near term. Those shares down about 5% on the day to the lowest levels since April. Those are some of our top calls. And we want to turn now to two big earnings reports that we got earlier today. Two companies that normally don't move the market, but a lot of attention right now, not so much on the quarter that's just passed, but, well, what the fundraising and the performance looks like going forward. We're talking about Blue Owl and we're talking about Ares, both reporting relatively decent growth here, plus 20% year over year. Our next guest accurately predicted public alternative asset manager stock prices could be volatile this month in her most recent note, and I'm pleased to say she joins us right now. Wilma Burdis is Director of Equity Research for Asset Management over at Raymond James. Great to see you, Wilma.
Great to see you too.
I'm not sure where to start with this. I mean, if you look at the numbers here, by any sort of objective measure, it was a decent quarter. But obviously, a lot of people are really focused on what type of cracks are underneath the surface and whether they'll materialize. You were on. I know you had a chance to ask some questions on the Blue Owl conference call. Did you walk away with some sense of confidence here that whatever softness might be happening in the portfolio level is certainly manageable?
I really didn't see anything in the quarter that gave me pause. The fundraising was really a record quarter, which is great. The EPS result was also pretty strong, so nothing that really caught my attention. The credit, even with some of the different credit funds reporting over the last day, we're seeing credits actually holding in really well. So not seeing anything in the underlying results that indicates the market sell-off you're seeing.
And we saw the same thing with Ares, and we should point out the CEO of Ares Management, Michael Arrighetti, was on Bloomberg TV earlier today, and he kind of highlighted the idea of their exposure to the software side. I think they put it around like 9% or something. He also talked about the idea that the fundraising is still strong. You buy that?
Yes, it is. It seems to be very strong, and I agree. I think Owl said something around 8%, Ares at 9%. So the exposure is pretty manageable, and then they also have exposure to AI as well. So if you are a believer in the AI boom that's coming, then that's another area of growth for these companies as well.
Well, I am curious. I mean, if you think about the wipeout that you're seeing in BDC shares right now, the fear there is that actually the software exposure is much greater than what's being reported right now. There's an analyst who made the point in a Bloomberg story this week that if your software business is in healthcare, for example, while that's classified as a healthcare exposure, it's really a software exposure. So, I mean, these headline numbers that you're getting, 9%, I think it was, for Ares, can you take that at its face, or do you have to consider some of the other exposures that they have, how much they're exposed to this SaaS apocalypse, as some are calling it?
Absolutely. BDCs can be more concentrated, but at the holding company, because they're diversified across real estate and other asset classes, you see it's smaller at the holding company. Some of the BDCs are more exposed. I think generally, though, when you see what's happening with these software companies, they've grown revenue and EBITDA very sharply, really still growing high single digits. Owl talks about how their companies have grown revenue and EBITDA 40% since AI, since ChatGPT came out 2 years ago. So that's a pretty strong result. We're not really seeing a pullback in the results. And, another thing that protects investors is that there's a 30% loan to value. So you've got a 70% cushion before you see any losses.
It feels like the hits do keep coming, at least the hits to perception to some of these alternative asset managers. You think about last year, we were talking about cockroaches running around, and now it seems like it's all about software and some of the existential questions there posed by AI. What do you think this means for, some of the grand ambitions to draw retail into their products? Because whether or not it actually matches what's going on under the surface, could you see this sort of deterring retail investors who are just getting up to speed and getting familiarized with this asset class?
I think there's a ton of demand. I think it's going to continue to build. I think people will have questions, but they will ultimately get comfortable. The returns are still very strong, and the penetration in retail portfolios is very low, so there's a lot of growth to come.
All right, Wilma, really great to get some time with you. That is Wilma Burdis. She is Director of Equity Research on Asset Management over at Raymond James. And it's really interesting, Romaine, because you take a look at what's going on. First of all, the software names just getting absolutely thrown out the window.
Yeah.
You can make the same case for these BDCs as well, that maybe there's just indiscriminate selling going on right now.
Yeah, but there's a lot of questions too. I was listening to the Eric Getty interview that was on Open Interest this morning, and he made a nice defense of it. The idea is that look, you're always going to have some sort of softness here and there, but overall, when you look across the portfolio, but there is a lack of transparency to a certain degree. And I think Wilma's point too about whether things are, or your point, I should say, things are getting classified not as software or AI specific is something that I think has to be addressed long term. But those shares really taking it on the chin right now. Before we go, I just want to take another look at Bitcoin here, because it's continuing to deteriorate. While we were speaking with Wilma, it broke below 64,000. This does seem like a bit of a free fall, and we're going to get some earnings tonight out of the OG of sort of the Bitcoin treasuries.
I know a lot of these digital asset treasury companies, there's a lot of really important questions being raised right now. So it'll be interesting to hear a little bit from that company. But coming up, earnings continues. XPO shares trucking higher in the wake of earnings. We'll speak to the CEO next. This is The Close.
.30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Katie Greifeld. We're keeping an eye on a sell-off underway in the equity market, but one stock that is really defying the market-wide sell-off right now, XPO. They reported earnings earlier today, and boy, just absolutely soaring right now.
Yeah, I'm kind of fascinated by this because we talk a lot about sort of economic conditions, and I always love the companies that kind of give you a read on the economy. It's basically a trucking company. You buy something from a retailer, you buy something from a factory. At some point, if it's a small truckload, it gets put on the back of one of their trucks.
Yeah, absolutely. It's got to get to you somehow. I will say shares higher by about 5% right now, but for the week, higher by more than 27%. So what a week it has been for XPO. Let's join now with the man in charge. His name is Mario Harik. He is chairman and CEO of XPO. Mario, it's great to have some time with you. So taking a look at your results, you beat when it comes to adjusted earnings per share, beating the average analyst estimate, and it looks like you're outpacing seasonal trends overall here. So I'm curious to hear your read on that, whether, this is something that is basically industry-wide right now, or is this XPO specific?
Yeah, well, what we have seen in the fourth quarter was a acceleration of demand in the month of December, which was predominantly retail-led. But as we kicked off here the year in January, we are seeing a strength in the industrial economy starting to shape. Now, a portion of that strength was company-specific initiatives that we are driving in onboarding more business in new verticals that we are pursuing. But we also did see the early innings of the industrial sector improving demand. And you could see with the ISM manufacturing index getting published earlier in the week, we saw more strength in that new orders part of that index, which means that there are more demand for industrial companies.
That's really interesting there, the mix between, industrial versus retail there. So I was taking a look at some of the sell side reaction. You have an analyst from Truist pointing out that they see this setup as increasingly attractive as incremental volume recovery. It should flow through. Boy, it's been a long week. To an already more efficient cost structure. So talk us through how you see that dynamic shaping up here when it comes to volume. What you were saying about the industrial side of things, should that translate to more volume overall?
Yeah, so when you look at the industrial sector from a volume perspective and the transportation sector, we have been now in a freight recession for 3 years. And during that freight recession, what you have seen was a lower demand specifically for the industrial sector. Now, at some point, and we believe the Fed fund rate could be a catalyst for that, but as that demand starts recovering, you would see more demand for transportation companies go up. Now, specifically in the less than truckload sector, this is an industry that historically has been short on capacity. So any inflection in demand leads to not only more volume, but higher prices and higher operating margins over time as well. So for us as a company, we have a set of levers that we are driving to perform above the market. And when you couple that with a market recovery, it would be an acceleration of the results that we can deliver over the years to come.
Mario, can you provide, though, a little color here about the difference between, I guess, your kind of industrial manufacturing side of the business relative to what you're seeing with your retail-oriented clients?
Yeah, so if you first of all, in terms of mix, 2/3 of our customers today are industrial companies, and they cover the gamut of the industrial sector. What we have seen in the fourth quarter was the industrial sector underperform the retail counterpart, and we saw the retail sector actually hold well through the course of the fourth quarter. And here, early in the year so far, we are seeing the industrial sector pick up more steam than we have seen in the fourth quarter. Now, within that sector, there are certain areas like electrical manufacturers or electrical component manufacturers have picked up more steam. HVAC companies, similar outlook. Equipment for agriculture, we're seeing that also pick up steam as well. And then some subsectors have also been a bit slower. But again, it's still too early in the year to tell whether that's an inflection point or not. But we are seeing a bit more strength than what we have seen in 2025 or 2024 when it comes to the industrial economy overall.
It's interesting to see, revenue has kind of smoothed out to a nice growth rate. I am curious about the bottom line and whether that gets smoothed out as well. And if so, does that just come from more operational efficiencies or just faster growth? Where?
Yeah, so for us, Raymond, over the last 3 years, we have been able to improve our operating margin against a sub-seasonal demand environment. But that has been driven by the strategy that we are driving as a company. And the tip of the spear of our strategy is to deliver great service for the customer. Because we believe when you deliver a better service product, you can layer on premium services we can sell to the customer. And you also get to see us gaining market share and gaining higher revenue per shipment as a result of that. Now, we have been able to deliver on those kind of results in a sub-seasonal environment. So now when you start thinking about us driving the levers of our strategy that includes service, an improvement in yield or revenue per shipment, and higher cost efficiency, these accelerate in the context of seeing more demand in the environment as well. So we've done really well over the last few years. And here the last data point is Q4 of last year with earnings growth and overall the bottom line growing. And that would accelerate in the context of a recovering macro if what we're seeing now is an early sign of that.
And Mario, we had a graphic up that shows that, the bulk of your revenue comes from the U.S., from sort of that North American market. But I'm curious to know what trends you're seeing develop in the rest of the globe, how that compares to what you're seeing in the United States.
I would say if I look at 2025 in Europe, so we operate both in North America and Western Europe, we have been seeing a muted economy in Europe. Overall demand is not coming down a lot or going up a lot. It's been sub-seasonal as well, and the macro has been on the softer side in our European operation. But similar to what we're doing in the US, we're expanding our sales force. We're expanding into new verticals that we didn't use to execute in or provide services in areas like aerospace or luxury goods or healthcare, and these are enabling us to grow revenues in our European business, despite the economy being flattish to slightly down from an overall demand perspective.
So Mario, talk about what comes next. I mean, when I look back at the evolution of XPO. And, we should point out, obviously, this was all kind of together before Brad Jacobs kind of, found a way to sort of create these kind of separate tracks here. You've been at the helm since late 2022. Congratulations, stock has done well. I think you're at a record high today here. But as far as like making this company bigger, does this get back to becoming an acquisition story, or is this an organic growth story?
This is an organic growth story and a compounding story when it comes to improving the operating margin of the business. So as we continue to improve our service product and grow in new verticals that are more accretive for us, and leveraging technology and AI to optimize our cost footprint, we are able to compound our margin growth and our earnings growth over time. And we're doing it by focusing on our customers and how we can best service them in the overall business. Now, when you roll that forward as well, we are, as our earnings growth, we are also generating more free cash flow. So that free cash flow, as it compounds, is going to enable us to return capital back to shareholders as well, which would further compound our earnings growth over time as well. So a lot of it goes back to execution. We have the right plan, we have the right people, and I'm very excited about the outlook over the years to come.
All right, Mario, well, we have to get you back here to talk a little bit more about that progress. Always great to have you. Mario Harik is the chairman and CEO over XPO, fresh off that company's earnings there, beat and raised quarter here, and the shares right now at a record high. All right, well, speaking of shares that are moving higher here, it's not the only bright spot out there.
No.
Did you take a look at Tapestry today?
Absolutely.
A huge move higher, which is impressive, particularly given such a down day in the broader market. We're going to talk about what's actually been fueling that company's resurgence, and well, it has to do with one word, Coach. You have a Coach bag?
Somewhere in my closet.
All right, well, we're going to talk to the CEO when we come back. Stick with us. This is The Close on Bloomberg. All right, well, XPO isn't the only stock trading at a record high. Tapestry shares charging higher after an earnings beat fueled by sales at its Coach brand. The company also raising its full-year guidance. Confidence on some of the inroads that it's made with a younger generation of consumers. Joining us right now to talk about that, I'm pleased to say, is the CEO of Tapestry, Joanne Crevoiserat. Great to have you here on the program on a really good day for you, a really good quarter for you as well. I know the last time we talked about kind of the resurgence of Coach as a brand, and that continues apace here.
Absolutely. Yeah. It's great to be here. Thanks, Romaine, Katie. It's great to be back. Telling our story, because I think the second quarter illustrates the power of Tapestry and the Amplify strategies we rolled out during our Investor Day. This company was designed for growth. These are intentional capabilities that we've built over time that are now structural. And again, you can see that in our second quarter results. If I could unpack it just for a minute.
Sure, go ahead.
What we saw was record sales and earnings in the quarter. And we're doing that with broad-based growth across the globe. We're driving and outpacing the industry substantially, driving share gains in China, in Europe, and in North America. And we're doing that on expanding operating margins and profitability while we're investing in the growth drivers for the future. So it's a terrific story. I love to tell it. And we're just getting started.
But with regards to sales, and I use the word structural, because I mean, in the fashion business, obviously we know things change on a dime. Has this sales growth been just because of better brand awareness, better marketing? Is it just finding a gimmick to get people into the stores, onto your website? Where?
Great questions. Yeah. And this has been about disciplined brand building. When we talked about our Amplify Growth agenda, that's what that's about. It's disciplined brand building. First, our brands appeal to a broad base of consumers, and we have tremendous opportunity to meet more consumers around the world. And our brand building capabilities have been designed to do just that. So it starts with knowing our target consumer. You mentioned the young consumer. We are targeting a younger consumer by understanding them, and then bringing all of that magic and creativity and innovation that is happening in our business, bringing that together with the insights and the logic and the data, and delivering incredible product, innovation, and value into the marketplace, and the consumers responding.
Well, it's interesting, Joanne, and I know this is a question that you faced on your earnings call as well. I mean, you think about the numbers that you're putting up. Clearly, the flywheel is in motion here, but you're going to be entering a period where you're going to have some pretty tough comparisons to match up to, which I have to imagine is a little bit of a happy problem. But how do you keep that momentum going? You talk about this careful, deliberate brand building. How do you make sure that, you continue to be relevant for that younger consumer that you're targeting?
Well, being relevant to the younger consumer is a muscle that we continue to develop, and you have to stay close because the world is moving very fast. So shopping behaviors are changing, lots of things are changing in the environment all the time. And when we think about that, that happens in North America, it happens in China, it happens in Europe. So we have to stay close to the consumer. But we've been disciplined and we have confidence because the TAM that we have is massive. We speak to so many consumers, and particularly at point of market entry, these new consumers coming into the category. Every year we see a new consumer who's coming into the category wanting to step into the luxury space, and they're looking to our brands to provide that first luxury purchase. We're delivering value and innovation that they recognize that they can reach for, and that builds a fondness for the brand for lifetime. We hear all the time about my first Coach bag. I remember when I bought my first Coach bag or my first Kate bag. That brings both fondness and brand love for a lifetime, but it also allows us to drive lifetime value for our business. So we see the opportunity to continue to bring more customers into our brands. We acquired 3.7 million new customers to our brands last quarter alone. That continues, and that's our focus. But while we're doing that, our existing customer base is also growing. So that's the compounding effect of the work that we're doing.
I'm curious how that differs, that strategy by geography. So this focus on the younger consumer, I mean, you're putting up impressive growth numbers when it comes to Asia, when it comes to Europe. Does appealing to that customer in those regions, does it differ from the North American younger consumer, or can you sort of paint with a broad brush there?
Well, it's interesting, and I'll answer it two ways. One, we have global strategies that resonate, and we also have regional teams around the world who are executing with excellence, and that's what we focus on every day. And that matters because how we bring the brands to life in each region may differ. Certainly the platforms where you reach them, how they shop may differ in each region. But what is really interesting is that we're seeing that this generation is the most globally connected generation. So a lot of the tensions in their lives, a lot of the things that matter to young consumers, we are hearing a consistency around the world about some of those things. So that makes the work that we do more meaningful. When we hear those themes, we can pull them out and put our investment behind marketing messages. And a great bag in North America, great tabby bag in North America is great in Asia and it's great in Europe. So that allows us to lean into the things that are common across the regions.
I do have to ask you, though, just about Tapestry overall as a company. I mean, we talk about Coach, and I know that is right now the dominant focus. You had 14% growth at Tapestry. All of that was basically fueled by Coach, 25% growth in Coach. Kate Spade, your other big brand, that is like a 14% contraction. What's going on with Kate Spade?
Well, 18% growth at Tapestry this quarter, 25 at Coach. No, 25 at Coach. These are standout numbers, I think, when applied anywhere.
But Kate Spade's not
doing anything. As we manage our portfolio, Kate Spade is a gem of a brand, and we know that it's authentic, and we can build that brand for future growth. And what we're doing right now is being quite intentional about how we're building the brand. The capabilities that we're building at Tapestry are Tapestry capabilities. You see them come to life at Coach, and they're proven strategies. We're taking those same capabilities and applying them to Kate. And we're in a phase now at Kate we call streamlining, which is getting more focus on the products and the messaging, removing deselection barriers, stepping away from promotional activity. So one step in driving a healthy brand is to step away from some of the things that turn customers off. A lot of discounting is one of those things. So we're getting more focused, we're stepping away from discounting. And where we're focusing our investment, we're seeing progress. We're seeing progress in building handbag blockbusters, right? We talked about the Duo and the Kayla. We're building handbag blockbusters that are outperforming the rest of the assortment with higher AUR. Driving higher handbag AUR is a consistent theme between both brands. And we're investing in brand building for the brand. Our fall campaign drove higher consideration rates, and we're beginning to see improving trends in Gen Z acquisition. So all of the disciplines that we're applying to Coach, we're applying to Kate. And we know that Kate will be another vector of growth for Tapestry in the future.
As you sort of make that push on Kate Spade, is that going to come with additional costs, at least in the short term, that investors should be aware of that could potentially weigh on margins?
Well, one thing you can see from our margin expansion this quarter is Tapestry is a disciplined organization. We're moving with discipline, we're investing in our growth, and we're seeing tremendous returns on that investment. Growing our operating margins by 390 basis points in a quarter is meaningful, fully offsetting tariffs in this fiscal year. And we're taking the same approach as we think about investment in Kate, making sure that we're continuing to invest to sustain Coach and making investments where we see return at Kate. And we have the disciplines and the rigor to make sure as we invest, we're seeing the returns. And if we're not, we're pivoting our tactics to make sure they deliver. And as I said, we are on track at Kate on our turnaround there. We expect improvement in the second half of this year and a return to growth in 27.
Joanne, just from the intention with which you're speaking about Kate Spade, I feel like I know the answer to this, but you talk about how you would be prepared to pivot. I mean, would you ever be prepared to say goodbye to Kate Spade if, the turnaround doesn't quite turn around?
Well, again, we're operating with discipline. We know that Kate Spade, we see and hear from consumers about the brand love at Kate Spade. So we're confident in the application of our capabilities to deliver that growth. And we expect, as I said, we are on track today, and we expect sequential improvement in the back half and a return to growth in fiscal 27. And we're confident in our ability to do that.
And management has said in the past that, you don't want to make another acquisition until you return Kate Spade to growth. Is that still the intention here?
Because it is, and it's because we see the value creation opportunity with our current organic portfolio. It is meaningful, that value creation opportunity, and we have a lot of runway ahead. So we talked a little bit and touched on the size of the TAM that we play in, but we speak to a broad cross-section of consumers. Our TAM is massive, and we have a low share today. And between our two brands, we can drive growth and value creation and really stand out incredible TSR.
All right, Joanne, it's always great to see you. Really appreciate the time today. That is Tapestry CEO Joanne Crevoiserat. Really interesting conversation. And again, a bright spot, Tapestry shares, when you consider what a downdraft this market is in. We're just about 8 minutes away from those closing bells. So let's take a look at where we stand on the broader level for the S&P 500 if we want to bring it up here. You can see that it's lower on the day. There it is. Yeah. Now down about 1.4%. You can see a lot of that pain is coming through in the tech space.
Yeah, we're back down to right around session lows once again on all of the major indices. And I think we talk about, the last couple of days when we had the quote unquote sell-off, it was more of a rotation, right? I mean, kind of just out of some of the high flyers into some of the lesser weighted names. But this seems a little bit different, what we're feeling today. It does seem people are a little bit more skittish. I don't know if it's about the earnings, if it's about the economy, or, maybe the sell-off in Bitcoin is just sapping, any kind of risk sentiment out there.
Or maybe a toxic combination of all of those things. There's a lot to be worried about if you want to find them.
Yeah, and it gets to this idea, too, as to sort of what's the catalyst, right? We thought that Alphabet might be that catalyst. The earnings were great by any objective measure. Amazon tonight. But after that, then you start to kind of, we're kind of slowing down a little bit in terms of the big cap companies. So what's left?
It's a good question.
All right. Well, let's pose that question to our next guest as we count you down to those closing bells. Closing bells now, just about 7 minutes away. Brian Mulberry joins us here in Studio 2 in New York, client portfolio manager at Zacks Investment Management. Brian, great to see you here.
Thank you.
What do you make of sentiment right now in this market? Are you seeing a constructive sell-off here, meaning people are maybe just taking profits, maybe rotating, maybe just being a little bit more cautious? Or are you seeing more of a wholesale, the sky is falling and let's get out?
Yeah, well, we certainly started the week negative in that we saw AI bots do some stuff that they hadn't done before, and that put some pressure on software, right? So we had memory stocks going up and software stocks going down. Today, we get kind of more negative sentiment piling on, to your point, in that now we see more layoffs announced. So the market is just assuming that AI is taking jobs, and this is really the compounding effect on the negative sentiment. Now, it's our job to kind of weed through that and ask what is really going on here. And yes, there's some successful use cases for AI bots doing some things, but it's not at a really big scale yet. Microsoft down in a big way. To your point, Google showing some pressure. But these companies are not going away.
Well, it's interesting you say that because Jensen Huang was speaking, the CEO of NVIDIA, at a conference. He was asked about the software sell-off, and he kind of said the same thing, similar that yeah, at some point, maybe long term, we are talking about some degree of disruption. But the idea is that these tools will still be needed from these software companies. But why aren't investors buying that? Because this sell-off, at least in software, this didn't start this week. This has been going on for a while.
Yeah, and that's true. And we've seen that rotation even just from style box to style box, right? We know that large cap values outperformed by about 20% over the last 90 days. I get that. But what is inside of that? There's some anomalies out there. We have some really high quality names that are under some pressure. So we think there's some buying opportunities swept up in some of the emotion of the market right now. What we want to look for is just durable earnings, right? There is a lot of money in motion right now. All of these hyperscalers, we're talking $600 billion that's going to be spent in this year in 2026 to grow out AI computing capacity. Those dollars are going to land on certain balance sheets. In our view, there's some really high quality companies that sit in the middle here where there's hardware manufacturers, construction companies, places that are going to benefit from the money that's actually being spent. And then that'll give us time to figure out what AI is and where it's going.
Interesting. I mean, I was going to ask, does that just mean NVIDIA? You think about where this money is going, but you make a good point. When it comes to that build out, certainly there's more tangible companies in the middle there. I am curious, though, what you make about the reception that we're seeing when it comes to this earnings season, because especially as you sort through some of the tech earnings that we've gotten in the past week or so, it feels like it's a pretty tough crowd out there. Does that just fit into this overall market malaise sentiment drawdown, if you want to call it that, or is there something deeper going on?
Well, I think investors are starting to ask the question about, okay, Google's going to spend more than we actually thought, and that was part of the call last night. So now we want to ask, when does that money come back to the balance sheet, and will it do so in a profitable way? So the return on invested capital, there's a lot of capital going out the door. When does that come back? When do we see that in terms of free cash flow, and how does that benefit profitability? There aren't clear answers, which is, again, adding to some of the negative sentiment that you're seeing in the market right now.
And outside of tech, if you try to look outside of tech, let's talk a little bit about the Fed. It's easy to forget that we had a Fed decision last week that got lost in the shuffle of the announcement of Trump's next pick to lead the Federal Reserve. What do you make of the influence of monetary policy at this juncture? Because it seems like we're on hold for now, and then we're going to get some cuts.
Yeah, I mean, the wider issue for us is that the longer end of the yield curve hasn't really moved. We've had 6 rate cuts in the last year and a half, and the 10-year Treasury is still well over 4%. That's the true cost of capital. Anybody that's trying to buy a car or get a mortgage knows that, right? Because if we can't get the 10-year Treasury below 4% sustainably, there won't be really cheaper capital out there. So that's more of the tipping point for us, is will the new Fed chair be able to tip the long end of the curve lower rather than just cutting short-term rates?
And that gets to the idea of whether the market's going to cooperate with that. We talk about some of the moves that we've seen in the dollar, and also just some of the volatility, particularly, I guess, around people trying to figure out what type of Fed chair Warsh really is going to be here. But it seems the consensus is that one way or another, it will be a more accommodative Fed, at least at some point this year.
Agreed, yes. Yeah. And we think that's probably obviously in the back half of the year.
The back half of this year, does that end up being a boost for corporate earnings, even if we do see more softness in the economy?
Well, I don't think it's an immediate boost to the large cap stocks that are under pressure today, but it will help sort out some of the small caps that are out there. We've not had a real regular IPO market for several years. A lot of that is interest rate driven.
Interesting. So, I mean, how does that sort of factor into the small caps? Because they have seen some pretty impressive periods of outperformance this year. We are starting to see maybe some of those IPOs return. We talked to the CEO of Bob's Discount Furniture, for example, earlier in the program. How does that bode for some of those small caps that can't seem to build a really sustainable rally?
I'll tell you, it's a big deal. If we get the 10-year down about 50 basis points, now you can really plan out some structures that allow these companies to come out of the private equity portfolios that they've been living in. So it could be a really meaningful change if we see the long end of the curve come down.
All right, Brian, great stuff. Great to have you. Brian Mulberry, Client Portfolio Manager at Zacks Investment Management. A closer look here at the sell-off as we move into the closing bells. And I do actually want to start off first, not with the stock, but with Bitcoin. It dropped back below that 63,000 level, now slightly above that there. But it gets to this idea here that there are a lot of people bailing, at least on the more riskier pockets of this market.
Yeah, it's going to be interesting again to get those strategy headlines expected after the bell. So Strategy's average cost basis for Bitcoin is at $76,000, just about.
I think we're
for
below
Bitcoin.
that.
We are below that. We've been here below for Strategy, but now we're getting meaningfully below here.
Yeah, so we got Strategy coming after the bell, and a few other names that could also be consequential for the market. We have Affirm, Reddit, I don't know if we count that, Microchip, Roblox, but then two that I'm really interested in. Atlassian, of course, software company that's been under a lot of pressure over the last few months. And then, of course, Amazon, which is, I don't know, it's a retailer, it's a cloud computing company, it's AI company, it's everything.
Yeah, really.
Yeah.
It's one of those conglomerates out there. Going to be fascinating to get that. And it's interesting, too, to think about their brick and mortar strategy, how they're approaching grocery. We're going to get into all of it once those numbers cross.
Absolutely. Here, as we wait for these numbers to settle, here on a day where you're looking at the vast majority of the stocks in this market to the downside. The Dow Jones Industrial Average losing about 600 points or 1.2%. The S&P 500 down about 85 points or 1.2%. The NASDAQ Composite down about 1.6%. And the Russell 2000, Katie, that's actually your main decliner here, down about 47 points or 1.8%.
Meanwhile, you take a look at sort of the breakdown here when it comes to the breadth in the S&P 500. As you've been mentioning, Romaine, we do have more losers than winners, 179 names in the S&P 500. Lower on the day, and that's really mirrored when you take a look at the circle, which we are right now. You can see that information technology, a giant weight there, down healthily 1.7%. Materials, too, down by nearly 3%.
We're waiting for Amazon earnings. MicroStrategy, now crossing the wire right now. The two numbers that you need to care about, revenue, 123 million. That's in line with estimates. The number of Bitcoin held, 713,000 and change here. And the company said it has a dollar reserve of about $2.25 billion as of February 1st, Katie.
Yeah, you can see the shares a little bit higher right now. We're going to try to digest those earnings, but I believe we have Amazon coming out as well. The first headline there is that fourth quarter net sales met estimates, Romaine.
Yeah, meeting estimates here. On the bottom line, we're talking about $1.95 on EPS. That's relatively in line with estimates, about a penny light there. The sales at $35.6 billion. That's above street estimates, slightly up about 34.8. We'll just round that up to 35. Operating margin in line with estimates. Operating income in line with estimates. AWS net sales up about 24%. That's about 3 percentage points higher than what the street was looking for. Physical stores 5.86, and overall net sales in North America 127 here. And here's your guidance here for the fiscal first quarter. The company is seeing net sales in a range of 173 to 178 and change. The street on average was looking for 175. So overall, Katie, this looks like a relatively, I guess, in-line quarter to call it, give or take a few bucks here and there.
And you can see that reflected in shares. I mean, we're down about 4% at the moment. Then we're going back to unchanged. So clearly, traders trying to digest just a slew of numbers here. But as you say, Romaine looks broadly in line. Let's get some more detail and insight from Poonam Goyal. She is Senior Analyst of U.S. Retailing with Bloomberg Intelligence, here to discuss these results in more depth. So I see their fourth quarter physical stores net sales came in at $5.86 billion, just light of expectations. I know you've had maybe 60 seconds to take a look at these results, Poonam, but what's your first read here?
I think just as you said it, the results are largely in line. But what I would say is AWS did come in ahead of expectations at 24%. The expectations were for 21%. So that continues to be encouraging. One thing that I think stood out to me, just quickly looking at this, was the $200 billion in CapEx that they guided across Amazon in 2026. That's a step up from where they were in 2025. So continuing to invest is a positive sign here. On the retail side, I would say, once again, things were in line, 10% online sales growth, really good numbers, continue to show that they are gaining market share.
Yeah. Well, I'm glad you brought that CapEx number, and great timing, Poonam. That redhead just crossing the wire right now, $200 billion in CapEx. The street was looking for about 146, 147. What's the narrative, though, going forward? Because when we saw these numbers yesterday, these eye-popping numbers out of Alphabet, I mean, some people said the same thing. Your colleague, Mandeep Singh, great, that's great. But again, at the end of the day, investors wanted to kind of hear some sort of articulation, not just of how much they're spending, but what they're spending on and what the return's going to be.
Yeah, so I think we'll hear that on the call shortly. So it'll be interesting to see that. I would say, look, the incremental spend that you're seeing from the 140 to the 200, it's got to be on AI. I mean, that is where these tech retailers are spending, and that's where we expect the spending to shift to on AI, on AWS more so. But what I would say here is the quarter at Amazon was a good quarter. When you look at Amazon against some of the other companies, you have to understand that it's a conglomerate. It's not just a tech company, it's also a retailer. And on the retailer side, they did pretty well from my perspective. I think they're continuing to show share gains. And on the AWS side, I think they're not going to be one of those players that are going to show you exponential growth at any point in time. It's going to be steady growth, and that's what we've been calling for years now.
All right, Poonam, appreciate you jumping on so fast. We'll let you get back to work. Poonam Goyal over at Bloomberg Intelligence. You see Amazon shares there at the bottom of your screen, down about 9% in the after-hours trade. We are going to return to that story in just 1 second, but we do want to turn to the software space. Atlassian just reporting earnings here. The company saying that its cloud revenue came in relatively in line with estimates at about $1.1 billion. EPS did beat $1.22 a share. The street was looking for $1.15. Operating margin higher than expected at 27%. And here's your guidance. The company says for the full year, look for revenue growth of about 22%. That's a slight bump up of more than a percentage point from its previous guidance. Cloud revenue of about 23% for the fiscal third quarter. The company also sees margin expansion for the full year and operating margin also going up. Those shares slightly higher here in the after hours trade. And pleased to say, joining us fresh off of those earnings is the CEO of Atlassian, Mike Cannon-Brookes, joining us right now. Mike, you've heard all the talk here. I thought software is dead. I thought Atlassian was being disrupted here. I know it's just one quarter. I know the forecast is only slightly higher than what you gave before, but are you committed to this long term? Is that sustainable?
Hey, yeah. Thank you very much for having me. We had a fantastic quarter. As you can see in our results, as you've just said, it's our third great quarter in a row, right? 23% total revenue growth, 26% cloud growth, our first billion-dollar cloud quarter, record number of million-dollar deals, and RPO growing 44%. So we don't give out guidance that we can't meet. I'm very confident that businesses continue to accelerate both on the cloud revenue side and we're accelerating the RPO, so our long-term commitments from customers.
Have you seen any sort of wavering in your customer base, any sort of pullback in demand, any sort of pullback in commitments?
Quite the opposite. We're seeing increasing growth and acceleration in the enterprise. We have, as I said, that RPO number of 44%. That's the third quarter in a row that it's ticked up. So our long-term revenue and performance obligations is growing faster than our cloud revenue. That reflects customers making long-term commitments to us in their business processes, their teams, and their workflows. You see that also in our NRR number. So we shared our NRR number is still north of 120%. And again, it increased for the third quarter running. So our customer retention, customer expansion, and customer growth all continues to be extremely strong in the current market, which we take as a vote of confidence in the work that we've done over the last 5 years in the enterprise and in the value that those enterprises see us delivering for them in the years ahead.
Right. Well, Mike, zooming out, I mean, you think about some of the fears that are running through your industry this week. I do wonder how you sort of AI-proof your business. I have to imagine that as CEO of a software company, this is something that keeps you up at night.
Look, there's a lot of noise in the market. There's no doubt about that, right? I've been very public. I think AI is one of the best things that ever happened to Atlassian and ever happened to my part of the software industry, software being a very, very broad industry. We help customers with their workflows, their business processes, and their teams, their human collaboration problems. A lot of what we do is around knowledge. A lot of what we do is around text. And AI and all its technologies are enabling us to deliver ever better customer outcomes. And we believe we can see that in our results, right? We passed 5 million monthly active users of our AI features, our Rovo Now, this quarter. And our latest offering in the Teamwork Collection, which we launched about 9 months ago, which is the best way to get our entire AI enterprise platform. We passed 1 million seats sold in the quarter, which is a record pace and exceeded our expectations for customers adopting our platform. So in terms of what enterprises want and what our customers want, I think they want the same things with AI as without AI. They want a strategic partner. They want to get better outcomes and more efficiency in their business. They care about security and governance and trust, and they want to get high ROI from their spend. And our software is incredibly affordable for those enterprises. And AI just enables us to deliver all of that and more. The existing contracts we have with our customers, their buy-in to us only gets better in the AI era, and I think we're delivering that in our numbers every quarter.
Well, I'd also love to go to this line in your earnings report. When you take a look at second quarter results, R&D expenses came in at just over $826 million. That is 22% year-over-year growth, slightly above the estimate of just about $117 million. Where are you investing right now? Where are you spending on R&D?
Look, we're investing across the board at the moment in R&D. We've always been a business that is long on R&D. We spend a lot of energy and time and talent on improving our products. Our customers sign up for a subscription. So as much as we can make our products better every day and every week, then those customers will be with us for forever longer. We're spending certainly a lot on AI and on our Rovo, on our Teamwork Graph, and making sure we have the best enterprise context that we can give the organization around our applications and other people's applications. We continue to spend on our enterprise features, as we see demonstrated in the number of million-dollar customers that we have, passing 600 this quarter on an ARR basis. So again, an all-time high and growing faster than it ever has before. So we're spending our R&D dollars on the areas that are most important in the current time to our customers and to our business. And I think in the current AI era that we're in, it's incredibly dangerous to be spending a small amount on R&D if you're trying to adapt and to continue to take these new technologies to your customers to solve the problems that they have.
I am curious. I know there's been a lot of talk about, particularly with companies like yours, the amount of investment you're making in AI on behalf of your clients or future clients. How much are you investing with regards to increasing efficiency in your own operations internally, Mike?
Look, that's also always a topic, right? We've continued to grow our free cash flow. We've continued to grow our earnings per share, as you see this quarter. So we continue to become a more efficient and a more sustainable business. We have a long, proud history, I would say, of growing free cash flow over the last 10 years of being a public company. And we're sustaining that growth both in revenue and in free cash flow and in margin. You can also see this quarter, great operating margin results, right? We had great gross margins. We make our overall software platform more efficient. Some of that R&D spending goes on AI and internal applied AI inside our teams to make our own business more efficient, more adaptable, and ultimately deliver cheaper products to our customers or deliver a product at a cheaper price. And I think we're doing a really good job, and hopefully it shows in the numbers there.
All right, Mike, really appreciate you taking the time for us. That is Atlassian CEO Mike Cannon-Brookes there, speaking to us right after his company's earnings. Let's get to some other earnings before we turn back to Amazon. I want to hit Reddit right now. This is interesting. Fourth quarter daily active users coming in above expectations, coming in at 121.4 million in the fourth quarter. I was one of them. Fourth quarter net income also coming in healthily above expectations. And here's the red headline. They're authorizing a share buyback program of up to $1 billion. You can see shares higher by about 6% right now. Remain clearly traders like that.
Absolutely. Traders also liking Roblox. It's the biggest mover in the after-hours trade, up more than 20%. Fourth quarter results, bookings up roughly about 40% to about $2.2 billion. Daily active users also beating at about 144 million. And here's your guidance. The company for the full year sees bookings in a range of 8.3 to 8.6 billion, rounding up. The street was looking for 8, even really on average here. The company, though, saying that don't expect a profit at all, still seeing consolidated loss for the year of 1.1 to about $1.3 billion. The low end of that range, though, is basically in line with the average of street estimates.
Well, shares absolutely flying right now for Roblox. But what isn't flying is Amazon. Shares of Amazon down after hours, you can see, by nearly 7%. Let's discuss with Dan Ives. He is Global Head of Technology Research over at Wedbush Securities. He joins us on set right now. Dan, it's great to see you.
Great to see you.
So let's talk about the big headline here for Amazon, 2026 CapEx forecast at about $200 billion. The average analyst estimate was for $146.11 billion. I'm getting a little bit of deja vu to just about 24 hours ago with Alphabet clearly causing some indigestion in the market. What do you make of this figure?
That's the narrative. I mean, these companies, look, they're in a position, it's an arms race. They have to spend when it comes to CapEx. The monetization, it's happening, and we're seeing that, obviously Meta and others, but it's not happening at a pace that investors like. And I think what you're seeing is they're selling these prints no matter what happens. I mean, from Google to Meta to Microsoft to others. Right now, it's, if you look at the tech trade, I mean, it is a white knuckle tech trade. And I think, look, the Amazon quarter shows you like AWS strength there. Monetization starting to happen. You look at like just overall consumer in terms of the metrics. The biggest issue is it's a balance because it's the third rail issue right now. How do they ramp CapEx, but then they're not going to raise guidance coming out of the gate to, massively, and that's why the stock's selling off. Yeah. It could be, we got to see how the conference call goes. Sometimes they're overreaction here.
Before we just go on, I just want to mention too, I mean, given the big sell-off that we've had here, now getting the headline right now, this involving a company called Liftoff is backed by Blackstone. It was going to be a pretty big IPO. We're getting a redhead now saying that they're postponing that IPO. Remember, this had already started marketing for that. We don't have a reason yet, but I think we can kind of deduce why.
Certainly a sign of the times.
Yeah.
And Dan, I mean, you mentioned when it comes to CapEx, it's a balance. So, I mean, when you're taking a look at these results, you're seeing these mega numbers coming out of these mega cap tech companies. Do you think that they're striking the right balance here when it comes to just these massive CapEx numbers that they are putting up?
I think they are, because for me, that's covered tech since the late 90s. If they listen to investors, what would they do? Like not spend in a fourth industrial revolution?
Yeah.
So bottom line is like Nadella, Cook, Sundar, Jassy.
Yeah.
Like these are ones that where like, look, they're seeing, just like the Godfather Jensen seeing it, you're seeing demand, 12 to 1? So their customers are basically all going toward AI. They cannot sit here and focus on just not spending, because otherwise they'll be watching from the stands the AI revolution. That's part of this arms race going on. We will sit here 6, 9, 12 months now, just like the DeepSeek moment a year ago, just like Liberation Day. This was the opportunity. It's not time to panic.
And when you say a Godfather, you're referring to not to Vito Corleone. You're talking about Jensen Huang, all right?
And wearing that black leather jacket.
I am curious, though, too. I mean, all the companies you mentioned, I mean, we've seen the eye-popping numbers today out of Amazon, $200 billion yesterday with Alphabet. You mentioned some of these big companies. Go down a level, and I'm just curious to get your thoughts on some of the software companies. We were just talking with the CEO of Atlassian, and you mentioned Jensen Huang. He actually defended some of these software companies, saying that this sell-off was kind of overblown, the disruption that investors seem to be trying to suss out isn't quite there here. Do they have a place, those kind of smaller, I don't call them second tier, but you know what I mean, those smaller companies in this AI race?
Look, I mean, I could tell you, like, in 25 years, this structural sell-off in software is unlike anything I've ever seen. I mean, I'm just saying in terms of the structural sell-off. If you look at Salesforce.com here, you have to assume that they're not just take the street numbers. You have to assume that they're actually declining the next few years. You have to assume with some of these companies, the ServiceNow, that they're losing 2-5% of their customer base based on these valuations. The point is AI a headwind to software? Yeah, now. But to say that software doesn't have a place, I'd say almost front and center in terms of the use cases. Palantir has been a perfect example. What we're seeing, I think we'll see with Snowflake and MongoDB and others. I think right now this is, it's really unlike anything I've seen. That's why I say ServiceNow, you look at Salesforce, you look at Oracle, Microsoft.
I do want to, though, ask you specifically about Amazon and what they're spending on. And there's been some criticism that at least what they've articulated, some people are saying, okay, what are they just going to be a cloud provider in this space? Or are you seeing more of an ambition there in the same way that you've heard from some of the other names you mentioned, particularly with regards to Alphabet, Meta, and I guess to a smaller extent?
Look, and Jassy's an AWS guy. I mean, the point is that they could, if you think there's more data centers under construction today than active data centers. So for their install base, they have to make sure that when customers decide to go to AI, down that path, they're doing with Amazon. Otherwise,
why not Alphabet? Why not?
Well, no, and a lot of times there's hybrid environments where you have all those. You could have Google, you could have Microsoft, you could have Amazon. But the reality is, who's the biggest cloud player in the world? It's Amazon. So they're not just going to sit here on a monetization of trillions of dollars, and they're going to go after that. Now, look, were they behind the ball relative to what we saw in Redmond relative to Google? But they're playing catch up, and that's going to be the narrative on the call, is that they cannot sit here and focus on being light on CapEx to please investors, because guess what? A year and a half from now, when you see other growth names that are beating numbers, 5-10%, Amazon's not, it's because they didn't have the CapEx.
But why is the stock plunging? And same thing with Amazon. I mean, with Alphabet yesterday.
Because right now, New York City cab driver is bearish on tech. Okay, and if you look right now, this is a situation where it's a do not enter zone in terms of software. I'm hearing from investors I haven't heard from in a decade. So when my cell phone's ringing at 11:30 at night from investors, it's not a good thing. And the reality is that, to me, there's panic in the air, but as I've talked about, this is not the end. It's year 3 of an 8 to 10 year build out. And it just comes back to, right now, look, the bears win the day. They're not going to win the year. I continue to think tech stocks are up big this year.
Well, it's interesting to hear your point that, if you're not spending now, 6, 12, 18 months from now when we're taking a look at earnings, there's going to be disappointment. In some ways, it reminds me of the narrative around Apple, that they were behind on AI. That was absolutely toxic for their stock. But when it gets back to the panic in the air, I want to go back to what we're seeing in the software space. Some have been calling it a SaaS apocalypse. You called it in a note yesterday, basically the software Armageddon. This is a garage sale. Which names do you think are being disproportionately punished here?
I think Salesforce, ServiceNow, and Adobe, investors are basically saying structurally broken models. That's what's baked into these stocks. Now, I disagree. So the point is, those are good examples of ones where, if you think that these are not structurally broken business models, those are names that stick out. Then you start to look at names like I said, Oracle. If you want to focus on CDS spreads and everything like that, the reality is they laid out the financing. You're talking about a company that's going to be front and center in this AI revolution. It's another example. And then you go down, there's names like Pegasystems. Look, the Palantir sell-off has been dramatic. Snowflake, MongoDB. It's very easy in these moments to just say, okay, software, it is a structurally broken sector. Let's see what happens when M&A accelerates from private equity and strategic, and then you start to see these numbers go up significantly higher over the next 6-9 months.
All right, Dan, always a great insight. It's always great to have you. Dan Ives, Global Head of Technology Research over at Wedbush, as we keep an eye on those shares at Amazon. Moving to the downside as we await that conference call. Of course, AWS always steals the show, but at its heart, this is still a retailer. That is the biggest bulk of its sales. But there have been some concerns about its foray into physical stores, particularly when it comes to groceries. The results that it reported for its brick and mortar retail efforts may be causing a little bit of concern here about what the strategy is going forward. Remember, it was just a while ago we learned that the company was shuttering its branded grocery stores and its automated grab-and-go markets. Joining us right now to discuss a little bit more about this is a man who actually helped to head the grocery division over at Whole Foods some years ago, Errol Schweizer, now a consultant advising companies in the grocery space. Errol, I never even knew what to make of Amazon's push into groceries. I remember when they first bought Whole Foods, a lot of people scratched their heads. Well, what are they trying to do here? Do they just want to use Whole Foods locations as warehouses, or do they want to be a sort of a pure play grocer? You had these grab and go markets, which I guess worked for some period of time and then didn't. What is, if you can assess it all from the outside looking in, what is their grocery strategy?
Yeah, I think they're still trying to figure that out. If you'd been in those Amazon Fresh and Go stores over the last couple of years, it looked like they were really mixed up. They were integrating a whole bunch of conventional and mass market items. They had a kind of smattering of Amazon and Whole Foods private labels, and then kind of cherry-picked some of the organic and natural brands that Whole Foods has made so popular. I think Whole Foods has been very clear about their strategy. Their growth has slowed considerably under the Amazon acquisition. They've only grown about 40% since the acquisition. Back up the last 10 years prior to the Amazon acquisition, they grew over 250%. So it's been much of a mixed bag with Amazon's acquisition of Whole Foods. And in terms of their own retail stores, I think they didn't really know what they were doing. That's not Amazon's specialty. They've never been keen on brick and mortar.
Yeah.
And I think what you said is accurate, is that, yeah, it's real estate. It is about acquiring real estate for the flywheel to get more customer data, to get more folks into their core business, which is online, which is 20 times the size of what they do in brick and mortar.
Well, first of all, I mean, there's the obvious issue of brand destruction. I mean, you know, I've shopped at Whole Foods for decades, and there's predecessor Fresh Field, so it's kind of weird to see how you had a brand with a very distinct identity basically be ruined. But I want to talk to you about the online portion of that, because that's a mess. I mean, anybody who's gone on to Amazon to try to figure out, I mean, am I going on Amazon Fresh? Am I going through Whole Foods? Am I going through regular? I mean, I've still never been able to figure it out. And I don't understand that even if they want to do the brand destruction on Whole Foods, why couldn't they figure out a more cohesive delivery model, which was, you know, let's face it, as a logistics company, which is at the heart what they used to be, you know, they were able to execute on that through the Amazon.com. Why couldn't they have consolidated that with regards to grocery?
Yeah, I mean, I do want to clarify. I don't consider it brand destruction. I do think it's a bit more stagnant than that. Whole Foods continues to innovate. They're doing some interesting stuff around regenerative agriculture. They're still a really strong organic player. They're still doing good stuff on innovation. They've just slowed down considerably. So I wouldn't consider it destruction. I think the key thing here is Amazon doesn't get people. At its heart, retail is about people. It's about service. It's about quality. It's about execution. You can't just lower prices. You can't just cut costs. You can't just have robots service everything. This is about people. This is about making sure people are paid well, they're treated well. I mean, you look at what's going on in Philadelphia, where Whole Foods employees tried to unionize, and Amazon not only has refused to bargain with them, but they tried to get the union decertified. You look at what's going on in Amazon fulfillment centers. You got 10,000 Amazon employees who've affiliated with Teamsters across over a dozen warehouses. Amazon's refusing to play ball with them. So at its heart, retail is about people. Amazon doesn't get people.
I just have to say on the point on brand destruction, a Whole Foods just opened in Hoboken, Romaine. I was psyched about it, and it seems to be a hit, at least, you know, on my Rivertown in New Jersey. But let's talk a little bit.
Their new stores are looking really good still.
Yeah.
You got to give them credit.
This
Their
one
new daily
seems
shop
to
is
be
pretty good.
in like an old bank, so the ceilings are super high.
Yeah.
And it's pretty.
You know, if Amazon just let Whole Foods run Whole Foods, I think Whole Foods would be doing great.
Yeah, well, there you have it. Well, let's talk a little bit about the relationship that they have with their people, because you point out in the notes that you sent over to our producers that their first union is 1 year old, but Amazon has refused to recognize it or bargain with it. I mean, how do you see this developing? I know it's a bit of an impossible question, but maybe an urgent one as we get closer or further into it.
Look, the only answer is them to sit down and bargain. I mean, just play ball. You know, this is about the democracy at the workplace, that these employees at Whole Foods voted to certify themselves as a union. So all you have to do as an employer is come to the bargaining table and hash out a fair contract. These are the folks that make Whole Foods happen. These are the folks that run those stores, they'll stock those products, order those groceries, make sure everything's fresh and rotated and sparkling and clean. They deserve a great contract. And really all you got to do if you're an employer, and look, I've been on boards that have been wall-to-wall union. I've worked with companies that are union. All you got to do is sit down and start bargaining and come up with a fair contract. That's all they need to do here. And they need to do that with the folks in the fulfillment centers as well. Slow rolling it or trying to decertify it, you know, trying to convince folks to vote against it or get rid of it. Yeah. That's just dirty. And really, the math says that unions are great for rank and file workers. They're better for pay rates, they're better for benefits, they're better for pensions, they're better for worker safety, they're better for free speech on the job. There's no reason. In fact, I would say those Whole Food stores would do so much better if more of them were unionized.
All right, Errol, unfortunately, we have to leave it there. Great to get some time with you in the wake of these earnings. That is Errol Schweizer. He is the former head of grocery over at Whole Foods. And of course, Romaine, thick and heavy when it comes to earnings coming out.
Yeah, I want to get to Molina Healthcare here, a big Medicare and Medicaid provider, down 30% in the after hours trade. Here's your guidance. Adjusted EPS for the full year, $5 a share. The street was looking for $13 a share here. The company talking a lot about here, the Medicare and Medicaid reimbursement rates here. Something to keep an eye on here as we talk about the impact of Washington on Wall Street. Absolutely.
You can see, wow, what a wipeout in shares right now. Well, coming up, we're going to pivot, talk a little bit about the Super Bowl coming up and betting overall with the CEO of BetMGM. This is The Close on Bloomberg.
All right, let's talk sports. Let's talk gambling. BetMGM setting its sight on Super Bowl weekend this Sunday after issuing a strong update on its business just yesterday. The company capping a record 2025 with what CEO Adam Greenblatt called robust engagement across its online betting and gaming platforms. Pleased to say Adam Greenblatt joins us right now live here on the big program. All right, Adam, let's get right to it here. I mean, obviously a good year. I think we're up 33% on sales here. And you're actually predicting a relatively strong Super Bowl. Give me a sense here of what you're seeing right now in terms of activity, given that it's already Thursday. And I think a lot of people, like most people at least, have probably already started to make their bets.
Yeah, well, look, the Super Bowl is our peak moment of the year. You know, for sports, for our sector, and BetMGM is no exception to that. And for us, it's going to cap off what has been an incredible season. We're expecting over $1.7 billion of wagered, well, in the legal market, to be wagered on the Super Bowl. That represents about 10% up from last year. That will be pretty similar to what we experienced during the conference finals, the conference championships. Our product is better than ever. You know, bettors will have an opportunity to choose one of over 1,100 ways to bet the game. As ever, the majority of volume we see on the six-pack, which is money line, spreads, and totals. But the money's, 65% of the money's on the Seahawks now. Yeah. In fact, one lucky BetMGM bettor has the Seahawks. He put $50,000 on to win $3 million.
Yeah. I am curious, though, too. I mean, there's a lot of competition in this space, Adam. You know that. I mean, I can go to BetMGM. I can go to DraftKings, FanDuel, a bunch of others. I can go straight to other traditional sports books here. I mean, how are you standing out? Because are you keeping up the marketing spend in order to sort of keep that brand awareness?
We've been much more refined in 2025 and much more selective in how we apply our marketing dollars. We feel our right to win is with the premium player. We offer our bettors a premium experience. And of course, our relationship with MGM Resorts is a key differentiator. One of the cornerstones of our strategy is this concept of omni-channel, where we bring our digital players into a real life experience. And frankly, this Super Bowl is, we've got a number of VIP parties around the country at obviously BetMGM Sportsbooks, but also at MGM properties. And so we're really looking after our best players in a physical world, and that connects that digital and retail experience.
Adam, I have to ask directly about prediction markets. When it comes to the competitive landscape overall, prediction markets seems to be, as you know, a space taking over everything, which is only slightly an exaggeration. How do you make sure that prediction markets don't come in and sort of eat your lunch here?
Look, I want to be clear about our position on this, and really, we, like our state regulators, now 40 attorneys general, all of our tribal gaming partners. We have serious concerns about sports prediction markets, not all prediction markets, but sports prediction markets, and how the sports prediction markets operators are seeking to circumvent the in-state regulatory frameworks designed to protect sports, consumers, and athletes. You know, the availability of nationwide sports event contracts basically undermines the regulated framework that has been built and refined over a number of years. And the sports prediction operators, they're paying no state taxes. They're offering no consumer protections. There are no penalties for underage. There are no self-exclusion lists, you know, whereby regulated operators protect those bettors and players who choose to sit out. There are no measures to protect game integrity. How much have we read about that over the last few weeks?
Right.
We, the regulated operators, have active monitoring requirements, obligations. We monitor betting patterns. We have whistleblowing obligations. So if we see something, we say something. There is no opportunity for this activity to continue in the future if every bet happens in the regulated world.
I hear what you're saying, Adam, but still, it seems like that is where the puck is going. If you take a look at some of your competitors, you think about DraftKings, for example, FanDuel, they've unveiled their own prediction markets. I know that, you know, where you stand on this is that that's not something you would participate in until the legal situation is clarified. But do you have any sort of timeline on that, any sort of expectation? And do you worry about falling behind here?
Look, ultimately, I feel like actually this moment in time we're experiencing is an opportunity for the legal and regulated sector, because what we're seeing is market stimulus. Really, the big spend and the high profile of the sports prediction activities, market activities, is stimulating interest in the category. And thus far, all of the legal determinations have been in the favor of the regulated sports betting operators and states' rights. And so, our position is clear. And as you rightly say, this is going to be determined in the courts. Yeah. And I fully expect that the volume growth we are seeing will flow back to those that are and continue to be regulated.
But you have confidence, I mean, certainly here in the U.S., and I'm talking more in the short term, as in over the next couple of years, given the current federal administration we have, and I know a lot of this is going to be determined by some of the state courts, but the general consensus, at least on Wall Street, is the idea is that the regulatory environment will be more favorable to Kalshi and some of the competitors in the prediction market. You don't believe that?
So make no mistake, I have no philosophical objection against prediction markets. I think there's outside of the world of sports betting, which is gambling, sports prediction markets on financial products and other things, frankly, is outside of the domain of this conversation. What I'm asserting is that we have a really thoughtful regulatory framework to protect the interests, as I say, of sports, of consumers, that is there for a reason.
So you've had no concern, though, just from a business perspective. Now, I'm not talking about the moral argument, even the regulatory argument, but the idea of losing potential customers that would have gone to BetMGM, that they might instead be going to some of those prediction market providers.
This is an important and current conversation, right? What we are seeing is we see no material adverse impact from sports prediction markets in our regulated sports states. As I said, we saw 10% growth.
What about in the non-regulated sports states?
Well, that we don't have visibility of. In the non-regulated states, frankly, those states have chosen not to adopt sports betting. And so what we're seeing is sports betting is being offered to residents of states who have very deliberately said, not right now. And so, back to the I don't even want to comment on that, the moral argument there. But from, the reality is our business is, players are telling us that they are choosing BetMGM and continue to choose BetMGM because of the product experience superiority, the direct relationship that they have with us, and the wonderful service that we offer our players that, frankly, an exchange does not have that kind of relationship with its players.
All right, Adam, that's a good place to leave it. Really appreciate your time ahead of a very big weekend. That is BetMGM CEO Adam Greenblatt. Meanwhile, let's take a quick look at some of the movers in after-hours trading on the back of earnings. Of course, we have to start with Amazon, down 8.5% right now. Traders spooked by that CapEx guide. Reddit higher, of course. They had that $1 billion share buyback authorization. Roblox also soaring right now. And Strategy down nearly 2%. We're going to be discussing next. This is The Close. Let's get a check on shares of Strategy right now in the wake of their latest report. You can see currently down about 3%. The real story is what's been going on over the past couple days, down over 28%. This week alone. That follows 2 other straight weeks of declines. Joining us to discuss is Mark Palmer. He is Senior Equity Research Analyst over at the Benchmark Company, who will be joining Sailor's Strategies earnings call in less than 15 minutes, Mark. So we have a deadline here. Let's talk through what we learned today. Of course, Strategy coming out and confirming that net loss of $12.4 billion for the fourth quarter, reiterating that they don't expect to generate earnings and profits in the current year or foreseeable future. And of course, their cost basis for their Bitcoin stash now below that level for the first time since 2023. You still have an outperform rating on this company. Tell us why.
Yes, for a couple of reasons. First of all, given the price action, the first thing we need to look at is what kind of defensible position is Strategy in. Is the company going to be in serious trouble because the price of Bitcoin has been dropping? And the short answer is no, because what you have to look at is the company's capital structure and the various obligations it has, the existence or non-existence of debt covenants and triggers and that sort of thing. Strategy has intentionally built a resilient capital structure. They have just over $8 billion in debt. That's up against something like $45 billion in Bitcoin, even at this low tick. So very, very well covered debt. They also have been issuing perpetual preferred stock, which is effectively permanent capital for the company that it can use to fuel its Bitcoin purchases. So in terms of downside, any of the claims that you might see from the trolls on social media and elsewhere, they don't line up with the facts. So in terms of the downside, we feel very comfortable. In terms of the upside, why are we bullish? Because we think there are reasons why Bitcoin could turn around and reaccelerate to the upside in the not too distant future, not least of which is the crypto market structure bill that's working its way through Congress right now, is currently being reviewed by the Senate, has significant support. We just heard Mike Novogratz from Galaxy Digital a couple of days ago assigned a 75 to 80% likelihood that that bill will pass in the next 6 weeks. If that's true, you want to be owning Strategy shares here.
So I am curious, Mark, specifically on that bill here. I understand a lot of people are speculating it could get back on track, but what actually gives you the confidence in that? And I don't mean it so much from the perspective of the investors, but the idea that the reason why this bill kind of stalled is primarily because of a couple of big players in the crypto space who seem to take objection to it.
That's correct. And there are some contentious issues, the single biggest one being the question of whether there should be interest paid on stablecoins. But I do believe that at the end of the day, cooler heads will prevail. I mean, this is a window of opportunity for the crypto industry such as we have never seen. There's never been a regulatory framework for the crypto space such as the one proposed in this legislation. To walk away from this at this point simply wouldn't be rational. So I do believe that nobody's going to be perfectly happy at the end of this process. That's typically the case with a negotiation run well. But I do believe that there is a strong likelihood that the incentives will come together and be aligned to get this finally written into law. If that does occur, that would translate into a huge influx of institutional capital that would uplift all crypto assets and certainly Bitcoin.
And I know you have to hop to...
By extension would help Strategy, of course.
Right. Well, Mark, before we let you go, I know you have to hop to the call. I do want to ask about Strategy, but also DATs in general, because, I mean, the fact remains that the trade doesn't work anymore. For, 2025, 2024, you could put in $1 and get $2 in the stock market. Now we have, Strategy. It drifted below its net asset value at one point today. A lot of other DATs have already made their way there. I mean, in some ways, it reminds me of what we saw with the Grayscale Bitcoin Trust before it was able to convert into an ETF. Obviously, we're talking about operating companies here. They don't have that option. So what do you see as the catalyst to actually close these discounts that are starting to form?
Well, the simple answer would be, first and foremost, do we see a significant appreciation in the price of Bitcoin? It would be, a rising tide that would help a lot of these boats. But the reality is that there are more digital asset treasury companies out there than need to exist. There's just not enough differentiation between them to justify them continuing to be in the space. So what do we anticipate is that there will be a shakeout. And that could take a few different forms. We've already seen one M&A deal in the space with Strive acquiring Semler Scientific. We could see more, but for the most part, I think we could get to the point that these entities simply decide to wind down. Yeah. Who would that favor? It would favor the large incumbents. Again, Strategy isn't going anywhere. They are by a large extent bigger than anyone else in the space. They have an advantaged capital structure. And as those other players leave the space, I believe its position would be even stronger.
All right, Mark, really appreciate it. Mark Palmer over at Benchmark. Let's keep the conversation going and bring in William Quigley into the conversation. He's invested in more than 24 ventures in the Bitcoin, blockchain, and cryptocurrency space, including being the co-founder of Tether and Worldwide Asset Exchange. And Bill, I want to start off actually talking about the treasury model here in in this space here, and whether, given some of the pullback that we've seen in the actual price of Bitcoin itself, does that actually still seem like an attractive business to you?
Well, the last time you asked me that question a few months ago, I gave you an answer, and the answer has not changed. Okay. I never liked those investments. I never understood why someone would want to hold the crypto in a vehicle that we all know when you have these AUM-based vehicles, they generally wind up trading below their net asset value. So why would you do that when you can buy the ETF? And so maybe they would have made sense before there were ETFs where it was hard to acquire and hold Bitcoin or Ethereum or whatever. But once ETFs arose, I never understood the logic of these vehicles. And they lasted about as long as I thought they would. I would give a little bit more credence to MicroStrategy because, you know, they started doing this in the summer of 2020 when there were no ETFs. And so, but at this point, I would expect strategy to trade far more closely to the holding value of the market value of their Bitcoin, and maybe at a slight discount because we usually see that with trapped AUM.
And I mean, we've already seen some players in this space kind of hobbled, if you will. Gemini today, everyone's talking about down on its knees. But with regards to MicroStrategy, I mean, Saylor has made the argument, and we just heard from Mark Palmer making the argument that the structure of the leverage that they took on, not to mention the fact that they were one of the early adopters here, so at least on a price basis, they have a little bit more runway. Do you buy the idea here that there is some semblance of protection there, assuming, you know, Bitcoin doesn't like crater to, you know, 20,000 or something?
Yeah, I do. I mean, they did a very smart purchasing method for their Bitcoin. You know, the corporation itself is not liable for whatever liabilities are in these bonds. They are backed ultimately and collateralized against the Bitcoin. So if they can't make a payment, they can surrender the Bitcoin. I think that was the right way to do it. But now, as I know a lot of people have talked about, for more funding, what do? Do they sell their Bitcoin holdings to get liquidity to pay off those bond payments, or do they sell equity? And obviously the markets don't like that because you've got dilution. So I don't know which choice they're going to make. They're both bad choices. You know, they're not great. But my concern was always with a very large holder like MicroStrategy, 3% of all outstanding Bitcoin MicroStrategy holds, that if they were ever in a situation where they needed to sell, it would put a significant damper on the price of Bitcoin.
Yeah, I mean, it's sort of fun to think about the hypothetical that if Strategy sold, what would that mean for sentiment, especially at a time such as this? But let's talk about the DAT landscape overall, because we were just having this conversation with Mark Palmer. He makes the point, even though he's still bullish on Strategy, that you don't need all the DATs that are out there right now. He would expect to see consolidation. Do you expect to see consolidation, or would you expect some of these DATs to just, you know, close up?
Whatever consolidation means, I'll take it to mean there'll be fewer of them tomorrow than there are today. Yeah, I'd expect that. There's not a compelling need. I heard many pitches of these things. And my question was always, why should I hold your stock with all of the idiosyncratic risks that your stock has versus owning the native crypto itself? What is that? And the only thing I ever heard was, well, we can stake it for you. But I can stake it myself, right? So it seemed like a lazy way to go about holding or buying this stuff. And I never thought it was going to be a long-term sort of investment opportunity for people. Maybe buy a miner if you were interested in that. Those have their problems too, but at least there's value add that the miners have, right? Hopefully they're mining at a cheaper price than the spot price of the crypto that they're getting, right? That would be a reason to do it.
We have 30 seconds with you. I know you're no longer at Tether, but I have to ask, what do you make of their recent strategy to buy gold in size? In some ways, it feels like we've introduced a new central bank into the market.
Well, I think it's a good move because ultimately, remember, stablecoins are just cryptos collateralized with something that you think is going to hold its value. The U.S. dollar traditionally been a good place. Gold is a good kind of diversification strategy because in good times and bad times, gold is always something people will want.
Right.
So I think it's a good thing to do. What the right mix is between fiat currencies and gold, that I don't know. You know, they're going to use their judgment to make sure they have sufficient collateral to back up every tether that they have.
All right, Bill, great to get some time with you. Have to have you back soon. That is Bill Quigley. He's the co-founder of Tether and Wax. This is Bloomberg.
You know, Katie, earlier this morning, the cosmetics company Estee Lauder reported earnings. They weren't good. They plunged. Those shares plunged 20%. And now taking a look at Coty, which of course runs the CoverGirl brand, they're reporting earnings. But the key here, scrapping their fiscal 2026 outlook and warning of a weaker than anticipated fiscal third quarter, saying it's a complex market backdrop right
You
now.
can see how that is being received not well. Coty shares down by more than 14%. Rivaling Amazon here, now down 10% after hours.
Yeah, and this is I wonder if this is going to be a repeat when the cash session tomorrow of what we saw with Alphabet yesterday, where they reported the CapEx numbers everybody wants, but apparently they're looking for something else. I don't know what.
Yeah, we'll see how sentiment evolves, not dissolves overnight.
All right, we'll be back tomorrow here with a full breakdown of that and a big interview tomorrow morning with Raphael Bostic.